Hello and welcome back to Dividend Destiny, the home of international income investing. Today we're going to talk about why government and pensions won't save you. I recently got into a heated debate on Facebook with a former schoolmate on the issue of retirement and the paltry future return of his state pension. Let me be frank, if you're relying on the government to look after you in retirement, you're in for a big surprise. The state and public sector pension system in the UK and many other countries, for that matter, is best defined as an intergenerational Ponzi scheme. When you make a contribution from your monthly salary, the funds aren't invested. They merely go into a huge pool of tax from which the presently eligible individuals collect their entitlements. Worse still, the funds might be spent on military entanglements or whatever concern the government deems appropriate at that time. Thus, the money is not compounded and there are no investment returns that are generated. It's not like investing in your own brokerage account. As you'll see later, the compounding of dividends or interest returns is a fundamental component in the pursuit of real wealth over time. From that perspective, the state pension infrastructure is a complete farce, and in the coming years and decades, the chickens will really come home to roost. The aging population will grow, and younger generations face the prospect of working harder and longer to slow the eventual implosion of the whole system. The declining birth rate also will place emphasis on the millennial generation to shoulder the burden. Irrespective of this, more and more older adults are heavily reliant on the state pension, holding out for the day when they will be able to collect it despite the paltry sum at the end. There are notable exceptions to this flawed model around the world though. Norway, for example, has reinvested its surplus petroleum profits into a sovereign wealth fund that now totals $1 trillion in assets, or $195,000 per citizen. The fund is widely diversified and owns equities, bonds, and real estate assets that all generate returns, which are subsequently reinvested. There are several other countries with sovereign wealth funds as well, including Singapore, that serve as additional examples of nations with prudent financial planning. Norway is also noteworthy in that it has recorded budget surpluses for many years, whereas the UK and the USA have run up substantial deficits. Allow me to illustrate just how pitiful the state pension is in the UK. To qualify for a state pension, you must pay national insurance contributions for a period of at least 10 years, but need to contribute for 35 years to get the full amount possible. Assuming you could retire tomorrow, your state pension entitlement would be £164.35 per week, or £8,528 per annum, which is an abysmal return for a lifetime of labour. The money is locked up and frozen until you reach the eligible age, which is subject to increase, and when payments begin, they are factored in with your taxable income. This amount is insufficient to support even a basic standard of living. Your reward for paying national insurance, which is a tax, the government takes it by force. It's not even enough to cover your living expenses. So we have established that the government is not to be relied on if our desire is to attain financial abundance. And why should we be surprised by that? Let's also consider company or workplace pensions, which are an inherently better bet, despite some evident flaws. A major plus for company pensions is the fact that your employer also contributes to the scheme and the funds you pay in aren't subject to income tax. The money is still under lock and key though, until you reach the age of 55. After this point, you may withdraw some or all of the fund, with the first 25% tax-free and the rest taxed as income. Therefore, a careful decision must be made as to how much you withdraw as a lump sum and how much you preserve for regular income. I have a couple of pensions from both present and prior employment. The first is a scheme from my first ever job at 18 until I left 3 years later. As you might expect, it hasn't made me a millionaire, and I'm now in my mid-30s. This pension has since been frozen until 2043, but will nevertheless continue to accumulate at a really tepid rate. The scheme is invested in a UK equity index fund that tracks the FTSE All-Share Index, comprising approximately 600 of the 2,000 or so companies that trade on the London Stock Exchange. I have a number of concerns with this structure. Firstly, the majority of the fund is denominated in pound sterling. There is limited exposure to other currencies, and this can serve as an important inflation hedge. Moreover, if the UK market were to crash at an inopportune moment, one could lose a huge amount of money, just as they need it to live on. Therefore, international exposure is a crucial part of diversification for maximising returns and minimising risk. And that's what underpins the strategy and mission of this YouTube channel. As monthly contributions are made to a pension, you're essentially buying the market at whatever price it's currently trading at, without any discretion or due diligence. Furthermore, any income thrown off by the fund is reinvested, irrespective of the price once again. The fund is ring-fenced until you reach the age of 55, which is preferential to the state pension threshold, but still patronising to responsible and prudent investors that want to take ownership and control for themselves. In the UK, there is a lifetime pension allowance of £1.03 million, with any pension savings over this threshold taxed at 55%, the lump sum, or 25% on cash withdrawals. This sum is not a huge amount if you want to really enjoy your retirement. People that have worked all their lives and put money into pensions in good faith should not have to scrimp and compromise. It should be a time for enjoyment and reward, sampling everything that life has to offer and living in abundance that can then be passed on to your children, a charity or some other trust as part of your legacy. To this end, I would much rather take personal responsibility by building my own nest egg and choosing my own investments and educating myself, whilst minimising fees and tax. I advise that you make use of employer contributions to whatever pension scheme you have in place and contribute the requisite monthly amount. However, you should recognise that with state and workplace pensions, you are placing your financial future at the whim of the government, the central bank and the pension manager. It's much more desirable to educate yourself and take personal responsibility for your monetary affairs so that you can maintain your self-determination and freedom. You've been listening to Dividend Destiny. Thanks for watching the video, and we'll see you next time.